In today's episode, I'll talk about three very interesting stories. In the first story, I'll talk about SEBI's new changes on how SME IPOs will work. In the second story, I'll talk about SEBI's new report on how companies are paying royalties and why it may be a bit of a problem. And in the third story of the day, we'll talk about how India is an economy of contrast, so to speak. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 25th of November. Let's begin with the first story. SEBI, or the Securities and Exchange Board of India, has recently made some very important changes to how SME IPOs will work. Now, this is largely because while SME IPOs have grown very significantly in popularity in the last few years, things are not quite working as they should. You might ask, what is the problem and what exactly is SEBI trying to do here? Let me break it down for you in very simple words. Look, when companies need funds to grow, one of their options is to sell shares to the public through an IPO. Now, for SMEs, this process can be particularly tricky. They don't quite have the resources or even the reputation that larger companies have, and this can make it very hard for them to attract investors. Now, in order to address this, SEBI had introduced a dedicated platform for SMEs back in 2008. The idea here was to create a more flexible and accessible way for these businesses to tap into public funding. And since then, the platform has delivered pretty well. In fact, SME IPOs have boomed in the recent years. As of October 2024, 745 SMEs are listed on these platforms with a combined market value of about 2 lakh crore rupees. In FY 23-24 alone, 196 SME IPOs raised over 6,000 crore rupees, and FY 2024-2025 is very close behind with 159 IPOs raising 5,700 crore rupees until October. Now, very clearly, SME IPOs are no longer just a niche segment. They have grown pretty substantially over time. But this rapid growth also has exposed some major flaws in this space. Look, SME platform was designed to help companies grow for sure, but instead it is now increasingly being misused. Let me tell you some key issues that are creating a problem here. The first one is promoters cashing out. Now look, the entire purpose of an IPO is to raise money for the company to fuel growth, expand operations, and sort out other problems. But in many SME IPOs, promoters are using the offer for sale or the OFS mechanism in order to sell their shares and exit the business altogether. Now, essentially, they are using these IPOs as personal payday, so to speak. In FY 2021, OFS accounted for 30% of total IPO proceeds. By FY 2023, this number had jumped to 40%. So instead of the money going into the business, a large chunk is actually ending up in the pockets of promoters itself. The second problem is the misuse of funds. See, many SMEs have raised funds without clear plans for how the money will exactly be used. Now, very often these funds are directed into vague categories like general corporate purposes or worse, into transaction with related party entities. Now, SEBI has found out some things which are fairly alarming for all of us. Half of all the SMEs had related party transactions that exceeded 10 crore rupees. 20% of SMEs relied on related parties for more than half of their revenue. So this raises some serious questions about whether these companies are genuinely looking to grow or they're just shifting money around. Now, SME IPOs have become especially popular with small retail investors who are hoping to make some quick profits. But the thing is, these IPOs are inherently riskier than those of established companies for obvious reasons. Once the initial buzz wears off, many SME stocks become very illiquid, which means they are very hard for investors to sell. Investors are usually left stuck with shares that they just cannot trade in. And therefore, poor liquidity has been a big issue in SME stocks for a very long time. I'll give you some very startling numbers as well. On the NSE, 27 companies saw no trades at all in the month of September and in the month of October 2024. On the BSE, 63 newly listed SMEs had negligible trading activity over the past 2 years or so. Now, SEBI wants to tackle these issues with a set of new rules. Let me tell you what they are proposing exactly. The first one they're proposing is to prevent promoters from treating IPOs as a personal exit opportunity. For this, SEBI is planning to cap the OFS portion at 20% of the total issue size or 20% of pre-issue shareholding, whichever is lower. The second thing they're doing is limiting individual shareholders from selling more than 20% of their pre-IPO holdings. Now, this ensures that the majority of funds raised in an IPO actually go into the company and are not really misused. The second strategy that SEBI is using is monitoring how IPO proceeds are actually used in the end. Now, they are doing this by lowering the threshold for mandatory monitoring of IPO proceeds from 100 crore rupees to 20 crore rupees, and this means that most SME IPOs will now face independent scrutiny. SEBI is also banning fundraising for unidentified acquisitions, which means companies must clearly specify where the money will exactly go. They are also capping the allocation to general corporate purposes at about 10% of the issue size, which is down from 25% previously. The fourth thing SEBI is doing is raising the minimum investment size. Look, currently retail investors can participate in SME IPOs with a minimum investment of 1 lakh rupees. Now SEBI wants to raise this limit to 2 lakh rupees or even 4 lakh rupees to discourage speculative investors and to ensure that only well-informed and risk-tolerant investors are able to participate here. The fifth thing they're looking to do is to extend promoter lock-in periods. Now this of course is done to ensure that promoters stay invested in their businesses for a longer period of time. To ensure this is implemented, SEBI is planning to extend the lock-in period for their minimum contributions from 3 years to 5 years. They are also phasing out any excess holdings over 2 years instead of the current 1-year timeline. The sixth thing SEBI is doing is improving liquidity. Now over here, in order to boost trading activity in SME stocks, SEBI wants to increase the minimum number of IPO allottees from 50 earlier to 200 now. The thought process here is that a broader investor base should, in theory at least, improve liquidity in these stocks. Now I'm sure at this point you're probably wondering, why does it even matter to you and why am I even blabbering about it? I'll explain. Now, like I mentioned earlier, SME platform was created with the best of intentions. It was to help smaller businesses grow by giving them access to public funding. But as things stand today, it is being exploited quite hard. Promoters are cashing out, companies are misusing funds, and speculative investors are making stocks unnecessarily volatile and maybe even illiquid in some cases. Now, SEBI's proposed changes here aim to address these very issues and restore the confidence in SME IPO platforms. If this is implemented well, these reforms could have very significant impacts. For retail investors like you and me, there could be better governance and stricter rules, which could mean reduced risks. For genuine SMEs, there could be a fairer system that helps honest businesses thrive and survive. For the market as a whole, there could be improved transparency and more credibility. So if I could summarize this, SEBI is today sending a very clear message. SME IPOs should be about growth and not about quick exits. These reforms could help ensure that platform delivers on its original promise, which is a way for smaller businesses to access public market funds and scale up sustainability. Let's then move on to the second story of the day. Look, there is currently an important discussion that is gaining traction in India's corporate and regulatory circles. SEBI, which is our market watchdog, recently released a report which throws light on royalty payments made by Indian listed companies to their overseas parents or related entities. Now, in case you're wondering why this matters or how these payments exactly work, let me break it down for you step by step. But first, before that, let's get a very clear understanding of what royalty exactly is and how it even works. See, imagine an Indian company that is a part of a larger global brand, say Nestle India for example. Now, in order to operate, it needs more than just local presence. It uses recipes, branding, and marketing expertise that is provided by its Swiss parent company in this case. Now, these aren't free. The Indian subsidiary of the company pays a fee, which is usually called royalty, to the parent company for using its intellectual property or IP and also expertise. Now, typically, these fees are a percentage of sales of profits. The idea here is that it's a fair trade. The parent company provides a valuable know-how and the subsidiary benefits in return. Now, if you think about it this way, it does make a lot of sense, right? But I'll tell you where things get tricky. What happens when these royalties become too high? See, if a significant chunk of the subsidiary's earnings is sent overseas as royalties, it actually leaves very less money for reinvesting in the business like expansion or innovation. It also leaves very little money for paying dividends to Indian shareholders. And SEBI's recent findings here suggest that these payments might not always be reasonable as well. See, SEBI examined royalty payments that were made by listed companies from 2014 to 2023, and they found what raises some very serious questions. In FY 2023 alone, 233 companies paid a combined of 10,779 crore rupees in royalties. To put that into some perspective for you, that is more than the annual profits of many mid-sized Indian companies. So while most companies stayed within SEBI's limit of paying no more than 5% of turnover as royalties, some were actually paying so much money that there was so little money or even nothing left for shareholders. In 1 out of 4 cases here, royalties exceeded 20% of net profits as well. Some companies paid more in royalties than they earned in profits altogether. So this means shareholders got absolutely nothing. Even loss-making companies were not exempt from this. SEBI found out 97 instances where such companies collectively paid 1,355 crore rupees in royalties over the last 10 years. Many companies did not adequately explain these payments or their benefits as well. So this lack of clarity has drawn criticism from proxy advisory firms, which usually act as watchdog for investors. SEBI also flagged 79 companies that paid royalties consistently for 10 years. Amongst these, 18 companies saw royalty payments grow much faster than their profits as well. While royalties grew at a compounded annual growth rate or CAGR of 14.6%, their profits lagged at just 6%. Now, in order to understand this controversy in a deeper way, we need to understand a little bit of history. Look, back in the 1970s and the 1980s, India's socialist policies restricted foreign multinationals. Many were forced to reduce their ownership in Indian subsidiaries, and royalty payments were capped, which is at 5% of domestic sales or 8% of export sales. Then came deregulation in the year 2009. Now, in order to attract foreign investments, the government had removed caps on royalty payments here. Predictably, payments of course soared here. Between 2012 and 2019, royalty payments almost doubled to over 8,300 crore rupees. And during this period, just 5 companies accounted for 80% of all royalty payments. Although SEBI introduced a new rule in 2019 which required shareholder approval for royalty payments exceeding 5% of turnover, the issue still persists. Like I mentioned earlier, excessive royalty payments can very badly harm shareholders and also raise some governance concerns. I'll also tell you why. See, first, high royalties eat into profits, and this leaves very little room for growth or for dividends as well. SEBI found some cases where companies were paying more in royalties than they distributed to their shareholders as dividends, and this is of course a serious problem. Second is more of a question. Are these payments really justified, or are they a way for the parent companies to extract more from Indian subsidiaries? The third is that when royalties dominate the expenses of a company, then they have very little to reinvest in their own operations. This could very badly hurt a company's long-term growth. Now, for parent companies, royalties are definitely a legitimate way to monetize their global IP and expertise. But for Indian subsidiaries, the balance between fair compensation and excessive payments is pretty delicate if you think about it. So therefore, this report by SEBI just does not highlight this problem. It also raises some questions for companies, policymakers, and investors. First, should royalties really be linked to profits? Because currently the limit applies whether a company is profitable or not. Second, should companies disclose detailed explanation of royalty payments and their benefits? Third, many royalty agreements are open-ended. Would it make more sense to enforce expiry dates and periodic reviews on them? Now, SEBI's findings are pretty much a wake-up call for both regulators and investors. Parent companies do deserve fair compensation for their contributions, but not at all at the cost of the subsidiary's growth or its shareholders' interests for sure. So for now, all of us as investors should definitely pay some close attention to royalty payments in the companies that we all invest in. These figures can reveal a lot about where the company's priorities lie in the first place. And now with SEBI pushing for a change here, we might very soon see rules that better balance fair royalties with shareholder value. With that, let's move on to the third and the final story of the day and talk about how India's economy is a story of contrasts. See, India's economy is currently at a very interesting turning point. On one hand, there is plenty of things to celebrate about. There is solid GDP growth, there are booming services exports, and there is a push for better infrastructure. But if you dig a little deeper here, you will notice a more complex picture. While some sectors are thriving for sure, some others are struggling to even keep up. So the question is, what is really going on? Let me break this down step by step. Let's start by understanding about consumption, which is the money people and businesses spend on goods and services. Now, this accounts for about 60% of India's GDP. In very simple terms, how much people buy plays a massive role in shaping our economy. But right now, consumption is as uneven as the economy itself. In cities, high-income households are leading the way here. This year's festive season was a pretty strong one. Luxury cars, premium gadgets, and high-end fashion saw big sales. But middle-income families are still feeling the squeeze. There are rising food prices, and general inflation is forcing many people to cut back on non-essential purchases. Let's take the automobile sector as an example here. Sales of luxury cars are still growing, but mid-range cars, which are the ones typically bought by the middle class, recorded just 3% growth in the month of October 2024 as compared to last year. Fast-moving consumer goods or FMCG also tells us a very similar story. Urban households are spending less because of inflation because now they are buying fewer items overall. But that said, some areas of urban spending are booming right now. There is travel, dining out, and leisure activities, which are all seeing a major rebound, and this is fueled by pent-up demand from the pandemic years. Hotel occupancy during Diwali had hit about 72%, which is the highest since the year 2019. So while the wealthier households are driving urban consumption, middle-income families are actually cutting back and creating a stark divide here. In rural areas where 65% of India's population lives, the recovery is more cautious as well. A good monsoon has helped boost agricultural incomes this year, and government projects like road building and electrification are starting to trickle down as well. But overall, the progress feels fairly slow here. Two-wheeler sales are a great example. In October 2024, sales grew 14% year over year. This is an improvement, but the volumes are still below pre-pandemic levels. Rural FMCG sales have finally outpaced urban growth for the first time in 3 years. But this also comes off a very low base and does not quite indicate widespread recovery. So because of all of that, most rural households are currently sticking to only the essentials. There is very little room for discretionary spending. And while there are some signs of life in rural consumption, it is too fragile to provide a big boost to the broader economy right now. The overall picture of consumption, so to speak, is very starkly divided currently. Now, this imbalance is a bit of a challenge. A broad-based recovery in spending, particularly amongst middle and lower income groups, is very essential to keep our economy growing. But for that to happen, people need higher incomes, better job opportunities, and lower inflation as well. Without those in place, confidence to spend will just not return. Consumption is not the only factor driving the economy, by the way. Corporate investments, which is business spending on new projects and expansions, have also played a big role here. Now, over here, India is seeing another big gap. Private consumption, especially in services, is a bright spot. Domestic tourism is surging, and festive sales on e-commerce platforms have hit record highs, particularly amongst young urban shoppers. But inflation, like I mentioned, still continues to hurt purchasing power, especially in rural areas where demand is still weak. On the corporate side, many businesses are financially healthy after many years of reducing debt, but they are still not investing aggressively. Manufacturing capacity utilization, which is essentially how much of the existing factory space companies are using, is at 75% now. Normally, this needs to hit 80 to 85% before businesses start to feel confident enough to expand further. Some sectors here are exceptions for sure. Renewable energy and electronics manufacturing, which is supported by government policies like the PLI scheme, are attracting significant investments. But outside of these areas, corporate demand still remains pretty muted, and this reflects cautious optimism at best. Exports, by the way, are another key growth driver, and here India faces a mixed bag, so to speak. Merchandise exports, which is physical goods, cars, textiles, and jewelry, are struggling quite a bit. Global demand is weak, and traditional export categories like gems and jewelry have taken a big hit. Petroleum exports have also slowed down, partially because of volatile oil prices. Now, India's export basket also leans heavily on low-value goods, and this makes it vulnerable to global trade shocks. In contrast, services exports are thriving. The IT sector in particular has grown over 11% in the first half of FY 2025. Now, rising demand for technologies like cloud computing and AI has pretty much solidified India's position as a global leader in digital services, so to speak. This sector is slowly proving to be a stabilizing force as merchandise exports is faltering. But like I mentioned earlier, India's economy today is a mix of high and lows. Services exports, public infrastructure spending, and digital innovation are driving growth. But inflation, weak rural demand, and cautious corporate investment are holding it back as well. Public investment has been very crucial here. Government spending on roads, railways, and renewable energy is not just creating jobs, but it is also building the foundation for long-term growth of our country. Innovations like the UPI are making financial transactions much easier and more accessible, and they are driving broader economic inclusions. But challenges still remain here. Rising costs are squeezing company profits, as I mentioned, particularly in sectors like FMCG and automobiles. So for India's economy to grow sustainably, it does need a more balanced recovery, so to speak. This means addressing the barriers to spending, particularly for middle and lower income groups, controlling inflation, and creating jobs that inspire confidence in the country. Corporate investments also require a push here. We need policies that encourage businesses to expand across a wider range of sectors, not just niche areas like renewable energy. Diversifying exports will also help reduce our exposure to global trade disruptions. So with the right mix of policy and private sector action, India can definitely chart a course towards long-term sustainable growth. The road ahead is definitely challenging for all of us, but opportunities are equally significant. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, Ola Electric is laying off 500 employees across different teams as part of its restructuring effort in order to improve margins and their profitability. They reported a Q2 net loss of 495 crore rupees, which is a slight improvement from 524 crore rupees last year, but it is higher than 347 crore rupee loss in April to June quarter. Second, Tata Power has signed a $4.25 billion pact with Asian Development Bank or ADB in order to fund key renewable energy projects. This includes a 966 megawatt solar hybrid project and advanced battery storage solutions. They plan to invest 30,000 crore rupees in renewable energy, which aligns with India's goal of achieving 500 gigawatt of non-fossil fuel capacity by the year 2030. Third, Reliance Jio lost 7.96 million users in the month of September 2024. This marks its third consecutive month of decline. Total losses for them reached 12.74 million users. Airtel also saw a drop, but a smaller one of 1.43 million users. Vodafone Idea, on the other hand, lost about 1.55 million users. But on the other hand, very surprisingly, BSNL stood out here and they gained 0.84 million subscribers in September after also having significant additions in the month of July and in August. That's all the news and stories I have for you today. I hope you enjoyed the show and found some value in it. Please make sure you drop a comment down below with your thoughts and suggestions, and we would love to interact with you. As usual, this is your host Anurag Bansal signing off. I'll see you in the next one. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.